Good evening. I'm Ross from Lifetime Property Accounting. So I've got a casual webinar tonight. We're just going to go through a few property deals that are currently on the market. We don't sell properties. We don't get commission from properties. I'm not trying to sell you into something. We're just trying to go through the numbers. What do they look like? What do the properties, what would I sort of look at if I'm going to buy the properties? And yeah, I've got no fancy AI tonight, no fancy slides really. I'm going to start off with just a simple disclaimer and then we'll get into it. So, the boring stuff to start with. Obviously, this is reviewing current deals that we're doing in August 2026. I am recording this and I'm just going to double check that that is going, which it is. So, you can watch it later if you want to. Yeah, it's based on current information at the moment. It's not specific advice for you. So, yeah, if you're looking at buying properties, yeah, come and see me, come and have a proper appointment with me. But this is going to give you some great information, free information. Yeah, without the sales pitch, without me trying to sell something, just looking at what things look like. So I'm going to go out of that. And yeah, we're going to start with the first deal. My first deal is a little bit boring. I'm not going to show you pictures. I'm not going to show you the websites, but for the other ones, I'm going to. So my first property, it's a property that someone's actually purchased. They purchased it up in Auckland for 880,000. Yeah, it's an Auckland property. They're getting 680 per week, and it's a relatively new property. So what we generally look at with this one, we're just going to concentrate on the cash flow. And to be honest, we'll see how bad it is. This is not a good example. The other ones are a bit better. This is a poor cash flow example. So this is example one. It's in Auckland, or it's more South Auckland, newish property. So yeah, cost price was 880,000. You're going to get some extra costs with that. So you're going to most likely get a valuation, maybe a builder's inspection. There'll be legal fees and other costs, but you're also going to get some sort of cash contribution back from the bank. To make it simple, I've made those two figures the same. And I always work on 100% debt to start with. If you've got a whole lot of cash, awesome. That is great for you, but you want a return on that cash. Most people don't have a whole lot of cash. They've still got a debt on a personal house or debt on other rentals, so they're effectively borrowing the whole 100%. Yeah, have a check out on our website some of the articles on how to borrow 100% if you're not sure what I mean by that. But you're definitely very easy, very common to borrow 100%. Most property investors borrow 100%. Just while I think about it, if you've got questions, feel free just to type the questions in. I don't share them. I just read out the questions so that no one else sees who's answer it. And if it's a sort of a rental basics question, something to do with the properties I'm talking about, something basic, I'll answer it. If it's something more complicated, I won't. So with this property, we're thinking, yes, South Auckland, how big that demand is. And if you're getting serious, you'd talk to a couple of property managers. What's the realistic rent? How easy is it to rent? Is that rent sustainable? Let's be nice. We'll go 51 weeks and it's rented. This property is already rented at 680 a week. So a lot of people will talk about gross yield being 52 weeks times the rent divided by the purchase price. To me, that is not the right answer. It's the expected annual rent. So for some properties, that'll only be 48 weeks. For other properties, you'll hopefully get 52. It depends on the standard of the property, the location, the demand of tenants. So property managers are great to give you that information. This property, 51 times 680, 35,000 roundabout, divided by 880 purchase price, 3.94%. Interest rates at the moment, 4.99% for 1 year. So we straight away know this property is going to be negative. I've presumed it's the first rental property. So accounting is a lot higher. You're getting more advice. There's more costs to do the financial statements. It's generally about $200 a property on top of that. So if you had two properties, 2,200, three properties, 2,400, for example. We don't know the exact details of this property. I haven't actually searched them, but normally insurance somewhere around the $2,000 unless it's Wellington Christchurch. Interest rates 4.99%. I've got property management at 8% plus GST. Standard rates maybe 3.5. It's a newish property, so built within the last 10 years. There is going to be some repairs. Some things will come up. but it'll be relatively low. Um, so relatively low repairs, which is a key thing. If this was a villa, you'd find the repairs are an awful lot higher than that. So it's just being realistic with the property, how big the trees are, how many trees are. This is basically a brand new sort of house, small, easy care, not a lot of trees or shrubs or section, and yeah, basically brand new. So low repairs. Um, Seminars, subscriptions, often we'll recommend or we like people to join property investor associations. So I'm a member of Waikato Property Investor Association, for example, and maybe a little bit of travel. Maybe you live in Auckland. So with this property, this is my bad example. 35,000 in, 56,000 out, losing 21,000 a year. That's before we get to depreciation. Yeah, we'd often look at getting value it in to get a chattel's valuation. This one's already making a huge loss. I then look at a long-term average. What's going to happen over the next 10 years? Rent is going to go up. Interest rates are probably going to go up and down. I've got them maybe averaging 5.5%. All expenses are going to go up. Rates, insurance, we all know they're going to go up. So I work on that and I sort of work on a 10-year average. This property, ouch, it's not a pretty property at all. We're looking on average, and that is interest only. We are looking at losing 23,000 a year interest only. 34,000 on P&I, average over that 10 years losing if you went principal and interest. It is a huge loss. That is a lot of money going down. And the big thing, the first thing is just, can you do better? If you're wanting to buy more and more properties, what does a $21,000 loss do? It gives you a huge handbrake. Banks are not going to like you. Your serviceability is going to be pushed. Even if you have a good income, your first 22,000 is just going to prop this up interest only. It's not paying down the mortgage. It's just keeping it dead even. So yeah, for this, yeah, just terrible cash flow property. Yeah, straight away it is going to hurt your portfolio. If you want to buy more and more and more, it's going to make it very difficult. So this is my bad example, but this is one that, yeah, about maybe within the last month, that someone has talked to me about. This was a rental property that they've purchased. Yeah, obviously what you're hoping for is capital gains, and none of us know what's going to happen with capital gains. This is the numbers from 1996 through. So generally you go flat, boom, stir crazy with COVID, back a bit, flat market. The green line, 6.3%. So you can see in the past that property's gone on 6.3%. The big question is, will it go at that in the future? And none of us know the answer. None of us have a perfect crystal ball, but the things to watch out for is interest rates have jumped, or sorry, not jumped, decreased a lot in that period. So they've jumped from this, or dropped from the 6 or 7% down to the, what, we got down to the 2.5% or something like that. There's not a lot of room to go down further. Um, Immigration, net population gain is not actually that bad. The problem is that we're building so much more houses. So Treasury projections are about 4%. I don't think they've ever got it right, but that's the starting point. Most people are saying 3, 4, 5% maybe with wage increase. So I've got the line going up a bit slower, not catching up with that 6.3%. So some real basic numbers. I'm saying, yeah, over the next 10 years, expected to lose 228,000. Expected capital gain, 655,000, 400,000 net gain. It's all that's called gambling on capital gains. If the gains come through and this is your only property, hey, 10 years' time, you could be going, what on earth was Ross talking about? But the big thing is just, yeah, can you do better than this? Is this a real gamble on capital gains? Could you do so much better? So that's our first example, which, like I said, a little bit of the boring ones. Yeah, it's having a bad day with my sharing, so we'll just fix that up, move my right thing in and start again with that. Second example. So this is a property, and we'll drag it onto the screen in a second. 52 Robinson Road in Auckland. It's 1,049,000. Rent $1,315 dollars. So this is starting to get a little bit more interested. It's two dwellings on one. I will just find that property, and yeah, we'll start having a look at it. So I've just found that on realestate.co.nz. And yeah, if we start looking through the pictures, so it's two houses on one. You've got the main dwelling and you've got the minor dwelling, so more income from it. Um, yeah, older property, I'd say a little bit run down. Probably just needs some TLC in there. Big cost, obviously, you'd be looking at the roofs. Do the roofs need repainting long term? Windows, I can't quite see from that, but we'll be looking at, are they wooden until you need to paint them? At some point, you're going to have to paint the outside, some more cost. Outside grounds, yeah, around the tarsier on that is going to need fixing. It's going to need some love and attention. Plus, there's two dwellings. Um, so there's a layout there. One is a one bedroom. The other one is five-bedroom house. So you got two income streams, and obviously you'd look through the pictures, but yeah, this I'm seeing painting, repairs, TLC basically. You tend to love a care. Just a bit of work. Roof, yeah, maybe a bit of work on that as well. So you're looking at different things. What does it need? So like the kitchen and that doesn't look too bad. Maybe they could have done a better job and done some staging in there. Curtains looks all right. Painting carpets, all that looks okay. So that actually doesn't look too bad. But the outside needing a bit of TLC. Bathrooms are looking fine. It's actually not too bad in the main dwelling. And then I'm guessing that we're going on to the other property. So just looking through the pictures can give you some great information on that. Other thing that we're obviously interested in is what is the insurance. So often I go onto Initio website. I love it because it gives me a quick, yeah, 1 minute normally to work out the insurance. This one took me a bit longer to work out which one was which, and which one was the right property. But yeah, normally about a minute to do a quick quote. So you do a rental, you see what is the quote, and then you adjust it a little bit. So Initio gives you a quick quote, $1,700. The cost to replace the house is going to be higher, so we'd up that a little bit. There's two dwellings, it's going to be more than that. Um, Loss of rent, your rent is about 68,000 from what they're saying, so a bit higher. Two dwellings, the contents is going to be a bit higher. Yeah, you can play around with excess, so you could drop or sorry, increase the excess. So maybe somewhere around 2,500 for that. You can also look up what are the rates. The rates are about 5,000 with that. You can see the breakdown and things like that. Obviously, at the moment, watch water rates. Are they included? Are they not included? Is there something like a separate, yeah, environment rates or separate council rates? So Waikato environment Waikato rates would be a separate one. So let's put some of those things into our rental spreadsheet and yeah, see what we're looking like. So this is example two, which is our Auckland two dwellings. 1,000 sorry, 1,049,000. There's obviously going to be a little bit more cost to buy, but there's going to be more of a contribution. We'll do 100% debt again. The rent that they're saying is 1,315. If you're getting serious, first thing to do would be chat to a couple of property managers. Is 1,315 realistic? Is it sustainable? I would say a bit more rundown. Yeah, maybe 50 weeks. We'll go a little bit lower. The first thing you're noticing with this straight away is higher gross yield, 6.27%, whereas our other example, 3.94. So much better cash flow. Your insurance is going to be higher. As we said before, I think we're sort of 2.5, and our rate's probably 5.5 or something like that. I've got property management 8% plus GST, interest 4.99% fixed for 1 year, repairs. We've got two dwellings. They're going to need painting long term, more outside. Yeah, you're going to be a reasonable amount of repairs. I would sort of start 2.5, 3,000 for a standard property. I would say, yeah, this some of those are going to be shared, but there seems to be more, maybe about 6,000 a year, 60,000 over the next 10 years. That's very subjective, but it's going to be a lot more than the new property. Same, I've got some seminars, subscription, and travel. Oh, sorry, we've just been changing those on the wrong property. So we will just fix that up. Insurance was 2.5. I'll just check I left that on the 2,000 we had before. Um, Rates maybe 5.5. Everything is going up. Repairs 6,000. So what we've got is 65,000 off income, 66,000 of income, our 6.27% gross yield based on 50 weeks. Less expenses 75,000. We're still losing about 10,000 a year. Looking at that long-term summary, it is a lot better. It's not amazing. I would sort of like, yeah, I would still love to get better than that, but it's definitely a whole lot better than that 22,000. Yeah, it's so comparing the two, that South Auckland newish losing 23,000 a year interest only. This one's losing 8,200. So over 10 years, we're looking at losing 82,000. It's still gambling on capital gain. It's still negative, but obviously it's a whole lot better. And that's what we're sort of looking at is, yeah, does this create some more opportunities? A bit more on this property. The interesting thing that I would look at, and I don't think it quite works, but we would be straight away looking on a two dwelling property. The obvious is, can we subdivide it? Oops, trying to get my picture to come in. So this is my little snipping tool of what we had. So what we'd be looking at is, can we subdivide it? So try and get a color that stands out a bit. Yeah, so can we chop the property and somehow subdivide it off so that we end up with one title here and a second title here? Um, yeah, it would just be an interesting one. Obviously, it's much easier to sell two separate titles, two separate properties than it is selling one. If you're selling a home and income, your market's going to be a whole lot less. It's over $1 million. I don't know. If there's normally 10 people looking at buying a property, maybe there's only 1 or 10% of the market looking for home and income. So if you could subdivide it, it would make it a lot easier to sell. Generally, we'd be trying to gain 100, 150,000, maybe even 200,000 from a subdivision. So yeah, it would be worth looking at this, probably just starting off with council. Is this subdividable? What would it cost? What's our development contributions? And then probably at some stage, if you're getting more serious, talking to a surveyor, getting a realistic list of those expenses, and then to a real estate agent looking at what would each property be worth if it was separate, and you'd sort of need to look at it. They're pretty close there. How would it really work long term? Yeah, is that backland big enough? Yeah, or would you sort of need to yeah, would you need to cut it off more like through here? Would that give two good houses? Not where are you going to park for that main dwelling? And yeah, I suppose you'd have to put a garage in here somewhere. Um, yeah, it's trying to think all those things. It's not really doing it for me. I'm wondering whether this would really work, but it's a great way to add value as long as the numbers actually work for that. So yeah, interesting one. Like I say, just to look a little bit, see how that could work. Maybe there's some potential to add some value a bit further with something like that. Next property that we have. So yeah, with if you do have questions, like I say, feel free to ask them. Everyone's generally scared to ask in webinars and seminars and hates asking questions, but yeah, I don't share what they are, and often other people are thinking the same things. Next example, I'm not sure if I spelt it right, but it's for Casabella Lane in Hamilton. It's a commercial property. So we're 449,000 plus GST. So generally, whenever you buy a commercial property, generally you would be GST registered because your tenant is also going to be GST registered as a business. So from them, they're not really too worried that it's plus GST for things, and it's just how everything is normally done. Technically, for this one, your income's under 60,000, so you wouldn't have to GST register. But with true commercial, there's not really a disadvantage. When you sell, you generally sell plus GST. So you're not taking a loss on GST, whereas something like Airbnb you are. And the same for the rent. The tenant is normally claiming back the GST, so they don't mind what the GST part is. They're just looking at the figure. Outgoings is a big one that you have to watch. A lot of tenants are not liking paying the outgoings, and they're often trying to include the two in together. So putting the risk of rates and insurance going up back on the landlord. So yeah, that can be quite interesting as well. This is rented 25,500 per annum plus GST plus outgoings. So that means the tenant pays the rates and insurance. So what does that look like? What sort of numbers do we look like on that? And yeah, we'll go through a couple of different scenarios on this. So our rent was 25,500. Our purchase price was 449. You always use GST exclusive. So yield is 5.68%. So that's quite good compared with residential. And you're also not paying the rates and insurance. And generally, tenants will pay a lot of the repairs as well. So it's quite a different things. Often, yeah, you can get a loan somewhere around the 65%, maybe 60% as a commercial loan. And then either you'll have to put the rest as cash in or borrow it against your personal house. So then as a residential loan. So we've done those two scenarios. To me, with commercial, you need to look for the same things. You need to look for added value. Longer term tenancies are worth more. Just watch the guarantee for the tenant. Yeah, if you sometimes they're not worth the paper they're written on if the tenant's got no money, or yeah, if the business is about to go bust and there is no guarantee. I would much rather have multiple tenants. I'd rather have three smaller tenants than one big one. Risks, yeah, poor guarantee, poor tenant, short tenancy. If it's a customized building, it can be hard to tenant. One tenant, yeah, just reduces your or increases your risk. There's also earthquake is a big one. Um, Renovation costs, you can spend a lot of money, hundreds of thousands between tenants. If you're buying from the tenant, has the rent been jacked up to make the price higher? And yeah, other things is it's a lot more around the tenancy agreement, a lot more around that lease agreement and the legal terms in that. So you need to understand those. Let's start with the cash flow. So my first example is that we're borrowing the whole 100%. Like I said, most people don't have 157,000 cash just sitting around. So they've borrowed 65% on a commercial loan secured over the commercial property. It's generally a couple of percent higher than residential. So maybe about 7%. Often the terms are 10 or 15 years, so it's a smaller term. You have to pay back more principal. The rest residential may be secured over the personal house, 157,000 at 5%. We've done that over 25 years, so a much longer term. What you'll see in this is there's a lot of principal being repaid. So we've got 25,000 of rent coming in. The interest is 28,000, so we're losing a little bit of money, $2,800. We then get depreciation. So for commercial, we can depreciate a lot more. We can depreciate partitions, plumbing, electrical, non-load bearing walls. There's a lot more, plus carpets, heat pumps, all the normal chattels. So you generally get a lot more. We can get a tax refund for commercial. It's not ring fenced. That loss can offset a personal income or business income. So this property, we're making a cash profit, losing 2,800. We're going to get some tax back that's negative, so we're actually going to get a refund of 2,400. The problem is for cash flow is those two numbers are basically cancelling out, but we're having to pay back 14,000 in loans. Because it's a commercial loan, we're going to have to repay that normally 10 to 15 years, 11,000 a year back. So we're actually going to have to put in 14,000 a year. The good thing is obviously over 15 years, that loan will be repaid. You're then away, then your cash flow is good, life is great. And obviously over time, you're hoping that rent goes up. But like I say, business is hard out there. Rates and insurance and that going up. Yeah, tenants are not that keen on rent increases. The other occasion is what happens if you put the money in. So you've got 157,000 cash. That's awesome, but you obviously want a return on that. We've got the same loan, same percentage, same years. So what's happening is obviously you put some money in, so your interest is lower. 25,000 rent, less interest, 5,000, less depreciation. You've got a tiny taxable profit, tiny tax to pay. So you're making $5,000 paying some tax. The problem is that you're still having to pay that principal. So again, after 15 years, great. You've got a low debt property, or no debt property in this case, and you're way great cash flow. But for those first 10, 15 years, life can be hard. You're having to put in $6,000 a year, and you're also not getting a return on your 1,000, so 157,000. So your taxable profit is return on investment. You're getting a whopping 0.37%. That is not zeros or decimals in the wrong place. You're getting an under 1% return. So if you go, I put that money in the bank, you're going to get 2 or 3%. Put it in shares or funds. Yeah, it depends how nice I am to the shares or funds people, but hopefully 5% plus. Whereas this, you're only getting 0.37% and then hoping for capital gain. Return on investment, you're actually getting a negative figure because you're losing money on your money put in. So yeah, why commercial starts off great yield, 5.68%. You're not having to pay the rates and insurance and repairs, but the problem is you're generally having to pay that loan back quicker and also higher interest rate on it. So yeah, if you have a whole lot of cash, maybe not so bad. If you could borrow it all at residential rates, a little bit better. But yeah, often commercial is a lot harder. What happens if this tenant goes bust? Maybe there's a guarantee. Maybe you can get the money there. Maybe the actual owner's got, or the guarantor's got no money. Um, Maybe that tenant moves out. Is it a year before you can get another tenant for it? So yeah, just so much harder understanding leases. Like I've got down here, earthquake is a big one, understanding that. And yeah, wherever you go, there's empty commercial properties. There's some great properties everywhere I look. Great locations, great property. They still can't rent them. Yeah, my favorite example of Dick Smith, maybe I'm showing my, sorry, of commercial and maybe I'm showing my age, is Dick Smith Electronics. Used to be a big brand 10 years ago. Everyone would have gone, that's an awesome tenant. Well, there's a building in Hamilton, huge big warehouse. They were the tenant. It's probably worth 3 million or more. They went bust. It was empty for about a year. They then managed to rent it cheap to a gym. That 3 million probably dropped to 2 million overnight. They probably lost $1 million of value overnight. Then they had it empty for a year. They had to pay the rates and insurance with no income coming in. And now they're probably getting half rent or low rent still. And it's quite a few years later. So yeah, having a big tenant for a customized building, that's not sometimes a good thing. I wouldn't want Mitre 10 Mega as a tenant or Bunnings as a tenant because what happens if they close down? Who's going to go in there instead? And the same sometimes if you've got the brand new commercial building and you've got ANZ or BNZ, one of these top tenants in there, yeah, after 10 years they move off to the next new building and yeah, you can end up having to do a big renovation or empty for a while or potentially both. So yeah, hopefully it's given you a few thoughts. You've got a few more complications. Obviously, need to understand GST a little bit, and generally you want to keep a commercial building separate from any residential, just for the GST risk. That yeah, you want to keep GST separate. Cool, we're flying through these. So, yeah, I said about 45 minutes, I think, in advertised. I've got one example to go, and there's also a twist on that example. So, hopefully, close might be more like 10 minutes than 15 minutes. But yeah, just got a last example to go through. Not having a good day on my share screens at the moment. Obviously, Zoom is not liking me, so I will try again with it and hopefully fix that up in a second. Cool. Last example. This is one I was yeah, just searching through for different examples, different things we could do. I'll actually go back a step. I've got that commercial property for Casabella. Casabella Lane, this was the $449,000 property, entry level commercial. For those of you who don't know Hamilton, Casbella Lane is pretty close to the middle of Hamilton. It's a sort of boutique little lane, relatively close to the CBD. There's a lot of new buildings happening in the CBD. A new hotel coming in that's relatively close. Yeah, that is a big thing. There's a theatre that's just completed in the last year or so. Yes, quite a lot of new developments. Another new hotel going to go in between the theatre and this. So yeah, a lot of new development and things happening there. Like I say, boutique little lane. It's quite cute. Lots of quite cool little shops in there. Got a nice little feel for it. Um, but yeah, obviously that can mean more body corporate, more costs for your tenant. And even if you've got your tenant paying the outgoings, well, yeah, it still affects how much you can ultimately get. Um, but yeah, it's not a bad location. Good from all those sort of points. Oh, they've done it here. So yeah, so making sure I've got my directions right. Okay, so the property's here. So that's north. Yeah, the new Pullman Hotel is going in there. The river is over to the left. And yeah, there's a new hotel further past the Pullman Theatre. Yeah, like they've got in here, Wintec Bus Centre. Lots of great things around there. It's pretty close. Centre Place has been around for years, sort of CBD. CBDs in lots of places are a bit funny. There is some undesirable people around the CBD. You do get a little bit of that. Probably not as bad as Queen Street on Auckland. But yeah, still potentially should be customers, should be tenants, that sort of thing. Cool. Last example I've got is Webb Street, which is a Wellington property. So Wellington straight away, probably cringing a bit when I'm thinking Wellington. Um, but we'll just go through this and what it is. So this is something in the CBD, two bedrooms, one bathroom. Um, so you can see what the outlook is. You can make your own decision up for that. Obviously, quite trendy with their pictures and things like that. Looks quite good. You just need to think what this would look like if you owned it yourself and how it would work. Um, doesn't actually look like it needs much done to it. You'd be checking the sizes of the bedroom. It's 60 square meters, so just double checking, yeah, if there's any insurance problems with that. Just the roof a little bit there, looking what's above, what's around. Is there some potential issues with it? Um, yeah, standard sort of CBD apartment. Maybe a bit of work on the bathroom. I don't love the sink, but then it fits in there. You've obviously got quite a lot in there. So you've got a number above. So obviously apartments in Wellington, you're thinking earthquake leaky. They're the two big things that jumps to my mind. And yeah, just like everything, looking what is tenant demand. So this property with the red arrows, it's pretty close to your main sort of Wellington. Obviously, so good. I'm a runner, so I'm thinking, where can I go off running from here? Very close to, yeah, lots of places where you can get the outdoors, go running, biking, those sort of things, but also very close to the CBD. I like walking, so I'd easily walk down to CBD. So that's not too bad. Um, yeah, we'll start going through the numbers on that and what it looks like. So this is our third example. Um, So I've just got a question here. I can answer this quickly. Is there any place I can rewatch this? Yes, you can rewatch it. So we're recording. So you can just go into the same link and you should be able to watch the recording. And yeah, it's also going to be on our Facebook, on our link tree if that's where you found it. And we'll probably also put the recording up on our YouTube as well. So you can definitely watch it. So this property, 395, we'll start off with those numbers. Big thing with Wellington, the market is terrible. Yeah, so if you're looking at yeah, selling a property in Wellington, no, unfortunately, it's hard. There's not many buyers. Everyone's a bit down on Wellington. Less public servants. There's been job cuts. Wellington's not at its best at the moment. Good thing if you're buying, ooh, if it's 395 or more, how much could we offer for this, and could we get it for a bit less? So we'll start at 395, and we'll probably drop the numbers. 52 weeks apartment in Wellington. Yeah, I would really be talking to the property manager. What is the demand for two bedroom, one bathroom in Wellington? What's the sort of rent that we can get? I'm guessing a bit around that $500. But yeah, how sustainable that is, how big the tenancy demand is, how many others are empty at the moment, be really looking at, and also looking at, has it got the right things? There's no car parking. Sorry, there's a car park, there's no garage. There's probably not much storage. So you'd be sort of looking with the property manager, is it ticking all those boxes? Is it going to be easy? Body corporate, $8,138. Ouch. That is obviously a big cost, and that includes your insurance, and that's from the post. So obviously you'd be checking that, and potentially it's going to go up. We all know for Wellington, insurance is expensive, and costs are going up. Yeah, so that is nasty straight away. I'm just going to get what the rates are. And I think that was also on the post. So again, just be checking, is it actually realistic? Do we actually believe what they are saying? Rates 2,182 plus 1,500 water rates. One of the things, I've done an article on it before, is Wellington just seems to be jumping up. Their rates are jumping. So I've gone 4,000, a little bit higher, but yeah, be careful that those things are going up. Repairs should be low because body corporate should cover a lot of those. It should do the property and the outside. You're just doing inside, and it looks pretty good. Small two bedroom, 60 square meters, maybe 1,000 a year, 10,000 over the next 10 years. Kitchen didn't look too bad, maybe a little bit on the bathroom. Yeah, I've got some seminars, subscriptions, travel. So this property, 25,000 in, 38,000 out, we're losing 13,000. If we start to look, what's that average long term? Yeah, we've got a $14,000 loss, interest only long term. It's your classic gambling on capital gains. Yeah, I'd be very hesitant probably on that in Wellington. Yeah, unfortunately, try not to be political, but National stays in, probably not good for Wellington. They're trying to cut costs. Labor gets in, Wellington potentially is going to boom. More public servants, more spending. A lot of that spending in Wellington. Wellington's probably going to boom, probably a great thing. If it was me with this property, yeah, I don't know if it's quite my cup of tea, but if you were looking at buying it, I would be extremely aggressive. So rather than offering 395, what happens if we did our figures on 300,000? That obviously reduces our interest a whole lot, but we're still running negative. Over a 10-year period, still looking at losing a 8.5 on a pretty cheap property. So it sort of shows you're going to have to go something like 250 to get close to where you want to be. Getting down to maybe 100 a week you put in, yeah, it's still, you'd even have to really go below that because you'd be looking for cash flow more than capital gain. And like say, taking a punt, Labor getting in, or we know at some stage Labor is going to get in. If it's not this election, it'll be at some election. But yeah, I would sort of be that 400,000 purchase price doesn't excite me. I would be going way lower, perhaps something like that, trying to get it down to a lower cost. Would you be prepared to gamble 5 grand a year, $100 a week, 50, 60 grand, hoping that you get that initial boom back to 400,000, gain your 150,000 there, and then get future capital gains as well? So sort of putting that in a better number thing, I'm sort of hoping to buy it worth 400,000, but get a discount of 150. So have some initial kind of equity in it. And then I'm hoping the 400,000 goes up maybe 300,000 in capital gain. So I'm hoping after 10 years you end up with 400,000 equity, effectively doubling your equity. That would be the only play I would sort of, or one play that I would have for it. The other one that jumped to mind was Airbnb. So potentially, could you do it on Airbnb? Yeah, short-term accommodation. Airbnb's just been a bit lazy, but any short-term accommodation, yeah, there's other platforms, but Airbnb is obviously the well-known one for that. So I've just had a bit of a play out the side. So what happens if we could do 50 weeks at CBD? Could we get 3 nights a week? You'd be looking on sites like AirDNA to look at the stats, try and find out how much they are rented for, and then we'd be looking for how much could we rent this for a night? What could we sort of get for it? So on my information I had before, yeah, I did a search. What happens if I booked a weekend? So note this is a weekend in October, so you'd expect slightly higher rates. What's around that area? What are we sort of comparing to? So we've got a 354 for a two-bedroom. Looks a bit fancier, looks more spacious. We've got 183 for one bedroom. Yeah, we've got some cheap 126, two single beds, one bath. Yeah, not my idea of a good time staying there. 473, well, obviously, yeah, expecting it. Well, it's got a pool, two bedrooms, two bathrooms. It's looking more fancy again. But yeah, something like that's going to give you an idea searching what properties are there. Yeah, looking at what events are in Wellington, but you think a big city that you'd have some on. So maybe as a quick guess, maybe we go 250 a night, 3 nights a week. So yeah, that's 37,500. Big risk for Airbnb is GST. So we're looking, do we need to GST register or not? Maybe low capital gains. So potentially you might be tempted to GST register to get the GST back, but you're well under the threshold you wouldn't need to. Threshold 60,000. Um, Flat rate kicks in. We've done an article on this. So yeah, if you search some on our website or new GST rules for Airbnb, quite an old article now, 31st of August 2022. And I think I look about the same now. 4 years later, that's sounding good to me. But you end up paying under the rules, effectively Airbnb have to deduct a flat rate of GST. So 6.5% they have to deduct. So GST is normally 15%. You're not GST registered, so you're not paying the full amount. So Airbnb give you 8.5%. And then under these new rules, they pay a flat rate to the IRD of 6.5%. So you're effectively down to 35,000. Then you've got your accounting, your bank fees, your body corporate. We're still gonna, let's say we're not gonna GST, still got the same interest. We are gonna go back up to the 395 purchase price. You are going to have property management, Airbnb 15.5%, rates the same, repairs. So Airbnb, you're going to have more things. You're going to have plates that are going to get damaged, glasses are going to get damaged. You're going to double your repairs. There's going to be more things. And then we've got power and internet, relatively small. But you're still probably going to be 250. Yeah, a month of power, $100 for internet. So probably 350. So that's 4,200. You're going to have some cleaning as well, depending on whether you can charge that to tenants or not. I'll say that you manage to get that within the charges, but maybe you need to do a catch-up clean. You still probably 250 a month just to get it clean, keep it looking good. So what we're looking at with that is, yeah, insurance. You potentially might get other insurance as well. Insurance on your couch and your fridge and your TV and other things like that. So we're looking at 35 in, 50 out. What this is showing is you need a lot better than that. So at 3 nights a week being occupied, it's not good enough. Could you get 5 nights a week? I I think that's probably pushing it. You sort of need that maybe the 4.5 to break even. So you'd need 4.5 nights per week to break even. So it would be worth looking at that. But again, yeah, if you're sort of thinking 3 nights a week, you're running roughly the same rate, the same profit as if you just rented it long term. Airbnb is a bit of a job. Who's going to let the people in? Who's going to clean it? How are you going to do all those things? So yeah, to me, you'd want a better return. You want some cash flow from it. Yeah, you'd really have to investigate those nights per week. And yeah, I don't know the answer for Wellington. You'd have to explore that more. Again, if you could get that purchase price, if you could get it down to 250, it's starting to get a bit more interesting, a bit more exciting. But yeah, potentially at that stage, it's actually not making as much money as just straight out renting it. So yeah, that's my different examples that I've got. Yeah, hopefully you've got something good from that. Like I say, the whole idea is just to run through what I'd look at. What does the cash flow look like? And if you haven't picked up, number one issue, um, is cash flow on rental properties. Any stock standard rental you buy, it's difficult to actually make money. And all those examples we ran through, well, the commercial, if you put in cash, would make money. Probably any of them, if you put in enough cash, will make money, but that's like a band-aid over the problem. The dual income was probably the best, but it was still losing money. And yeah, that's the hard thing. It is hard. You really need to add value. So adding bedrooms, subdividing, adding dwellings, yeah, buying multi-unit properties, those sort of things can work. The only one I'd really be serious with this would be the two dwellings in Auckland, but ideally I'd want one that I could subdivide, one that I could separate up, and maybe where rather than a one bedroom minor dwelling, where there was opportunity to turn into two or something like that. Um, just some other information I'll quickly share that I've got sitting on my screen waiting. Something else that's interesting to look at is Stats New Zealand information just on areas. So this is a while ago now, but this is the population projections for New Zealand. All I've done is added the percentage out the side. So from 23 to 2048, what percentage gain? So we've got Auckland, Wellington, good. Gisborne, you'd be a bit more hesitant, not expecting big population gain. So, not so many people. Rents might stay stable, and prices might not go up. Something like Wellington, 11%, it's okay, but yeah, be careful of governments around that. Something like West Coast, you'd obviously be very hesitant with that because it's a negative. Southland, yes, the same, 3.61, very low percent um, population increase or expected. Interesting thing, this is obviously done a few years ago by Stats New Zealand. If you look what's happened to property prices, this is saying higher population growth North Island, lower South Island. But obviously the last 2 or 3 years, property prices have gone up more in the South Island. It's still useful to look at it though. It gives you good information. Upper Harbour, good in Auckland, Franklin, Pukekohe, Selwyn, and Christchurch. Those are your big three areas. Your bad areas are terrible. Ruapehu, especially if the mountain goes bust, or if there's bad snow years. So obviously, Ruapehu. The two sides, Whakapapa and Tura, have recently been sold. Both those businesses will be having a relatively rough time. It's their first couple of years. They'll be reliant on good numbers coming through. If something happens to them, that can really kill the Ruapehu area. Bulla minus 15%. Timaru, I'd probably get shot if I did this down in Christchurch or did this down in Timaru. But yeah, important to look at those population projections. They're quite useful and can help you just on, yeah, what could be some good areas or potentially what could be some bad areas. Yeah, so hopefully yeah, you've got something out of that. Hopefully you've got some good information. And yeah, feel free to ask any questions that you might have. But yeah, otherwise, yeah, this is recorded on the 16th of September. I've got a free webinar coming up, and I'll just find my PowerPoint. Um, So yeah, on our link tree, we have webinars that are coming up on our Facebook group. We also on our Facebook page, sorry, we also put them up. So that's what you can see. And yeah, we've got rental basics coming up on the 16th of September, I think. It's just got some great information about some different ideas if you're new to property investors, some tips maybe as a first rental, what you could look at. And again, no sales pitch. I'm not trying to sell properties. So hopefully you've enjoyed that. Hopefully you got something out of that. And yeah, we'll see you next time. I'll hang around for a minute or two of questions. Classic comment here. I'm not trying to hassle you, but you always get them. Everyone loves their areas. So this person's done well in the South Island West Coast. Yeah, it's just somewhere to be aware of. That obviously the population projections from Stats New Zealand is declining. If that happens, less people, will that mean less houses are required? It's just something to think about. And generally, if you become a real pro in your area, someone who really understands it, you can do well anywhere. It's just added risk if you've got declining population. I'd much rather a bigger city, more people, more tenants, more buyers, and ideally somewhere that's going up well. So Auckland, Wellington are sorry, Auckland, Waikato are the classics, expecting 20% gain. Christchurch is obviously booming at the moment in construction, but the actual population gain is not that big. There's an article for Airbnb recently, 48 new residents, I think, in Christchurch CBD, 500 houses. So they've each got 10 houses each. So yeah, lots of different things to think about. But yeah, at the moment, South Island is definitely going up, whereas North Island isn't. West Coast, yeah, I would just say either be an expert or keep away. Cool. That's awesome. Well, we'll leave it there and hopefully you'll have a great night. Thanks a lot. Bye.